Hello everybody and welcome to Greenstar Trading with me Tom, and also welcome to this first video in a new series called An Introduction to Elliott Wave Theory. Over the coming weeks and months we will discuss all the various types of Elliott Wave counts that you can use on your own charts, and hopefully by the time this series is over you'll have a broad knowledge of exactly how to do that. This series will run alongside another series where I look at different stock charts. We've been looking at Tesla recently, and in that series will be a much more open-ended and broader use of technical analysis techniques, where we will look at everything from simple trend lines and pitchforks, shift and modified. We'll look at chart patterns such as tops, double tops and double bottoms, and all sorts of other price patterns. We'll look at use of moving averages, simple and exponential. We'll look at fib channels. We'll look at volume profiling. We'll look at all sorts of different oscillators such as the Williams-R, the McClellan oscillator, the relative strength index. We'll also look at the MACD, and we'll also be applying Elliott Wave theory to those charts the whole time, building up a count as we go. It'll be a much broader use of technical analysis on an actual price chart, so you can see how I layer it in order to figure out what's going on. And it should hopefully be full of a whole bunch of handy tools for you to use as well. However, in this series we will be focusing purely on the theory of Elliott Wave without price charts to distract us, and I will lay down all the different counts you can observe and the rules which you must follow and the guidelines around those rules. And that's it. So without further ado, let's begin. In this episode 1 we will be looking at the impulse wave. Now the impulse wave is a 5-wave structure which you can see on the chart. It can go 5 waves up or it could go 5 waves down. And the simplest way to think about the impulse wave is to think of the trend, because that is literally what we're talking about. The trend up or the trend down that we can see on the chart in the market. We start at a low, we finish at a high. We start at a high, we finish at a low. And it's the easiest way to think of an impulse wave. You are just simply observing the trend and trying to follow it. There are, however, a series of rules which must be obeyed when identifying an impulse wave. Wave 2 cannot retrace wave 1. This is rule number 1. That means that this wave here cannot extend beyond the start of wave 1. Rule number 2. Wave 4 cannot retrace the top of wave 1 unless it is a diagonal. Now we will cover leading and ending diagonal patterns in our alternative motive waves in a future video, but for the moment we are focusing purely on the impulse wave, and this rule is strict. The 4 cannot retrace the top of the wave 1. Our third and final rule is wave 3 cannot be the shortest wave. Wave 3 in itself can be shorter than wave 1. Wave 3 in itself can also be shorter than wave 5, but wave 3 cannot be shorter than both wave 1 and wave 5, the other two motive waves in our impulse wave. Now that we've discussed our rules and have established them, let's talk about the subwave structure of each of these waves. There are 3 motive waves, each made up of 5 subwaves, and there are 2 corrective waves, wave 2 and wave 4, each made of 3 corrective waves. Let me show you what I mean. Each motive wave is itself made of 5 lesser waves. This will be the wave 1, the wave 3 and the wave 5. Each corrective wave, the wave 2 and the wave 4, will be made of 3 subwaves. These will be labelled differently from our motive waves, which are labelled using numbers. Our corrective waves are labelled using letters. Now, you may have noticed that the numbers on the impulse wave that we're looking at are circled 1, 2, 3, 4, 5. But the numbers in our subwave are bracketed 1, 2, 3, 4, 5. This is to help you identify waves of greater and lesser degree. A subwave here is the intermediate wave 1, 2, 3, 4, 5 in its bracketed form. The wave 1, 2, 3, 4, 5 in its circle form is the primary wave. And there are a multitude of waves above this level and below this level. Above this level we move to the supercycle, we move to the cycle wave, the supercycle wave above that. Below this level we move to the intermediate wave, the minor wave, the minute wave and the minuet wave. The same is true of the corrective patterns. The A, B's and C's are also built of subwaves themselves, which are of lesser and greater degrees depending on the overall structure you're observing. So let's just hide these where we were, back where they were. So we've covered our rules, we've covered our subwaves, which can be expressed very easily for an impulse wave as 53535. And that's it. Now we've established that, we need to establish how to find our waves when looking for them and where they are likely to complete. And we can do that using a series of Fibonacci relationships. So the first thing we're going to need to do, if we're using TradingView, is go to the left hand menu, scroll down 3 selections, open the tab, and halfway down you will find Fib Retracement Tool and Trend Based Fib Extension Tool. Now I favourite both of these so I can have them in my bar, my favourites bar, at the top of any chart which I can move around at will. So the first tool we're going to be using is our Fib Retracement Tool. We're going to be coming to the bottom of where our wave 1 began. We're going to move up to our wave 1, and this is why I positioned the white dashed lines where I have. This means I don't have to position the Fib tool exactly on where the one began or exactly where it finished. I can use the white lines so that I can make the number that I'm looking for more observable so it doesn't get in the way of price data. It's just a little habit I do. It's not an essential and you don't have to do it. It just helps me. So let's zoom in a bit and see where this wave 2 retraced to. Unsurprisingly, since I put it there, it retraced to the 61.8%, which is the target we're looking for. Now, although this is the target we're looking for and has the greatest probability of a wave 2 completing in this region, it doesn't have to complete here. However, as a guideline, we would expect to see it at least retrace 50% of the prior wave 1. It could go to the 61.8 where we would expect to see it, but it could go to 65%. Now this is often a case of what I would call an overrun or a bit of slippage in the price. We were essentially aiming for the 61.8 and went a little deeper. Beyond this, there are other Fibonacci targets. Now I have several number targets on my Fibonacci retracement that I personally use, but you will standardly just have the 61.8, the 78.6, the 100, the 38.2 and the 23.6. Now if you go past the 61.8, your next target is likely the 78.6. But because of our rule, remember, that we are observing, that wave 2 cannot retrace to wave 1, the other side of that rule is wave 2 can retrace as deeply as wave 1. If we just find our wave for the moment, we can move down to just shy. As long as we don't go past the wave 1, we're still legal. We can come down to 0.00001%. Okay, to 99.999% and still be legal of a retracement of wave 1. We just can't go beyond it. This is very rare, but can happen. Now, our most likely target though is going to be our 61.8, so that's what we're going to be looking for most of the time. That's your wave 2 retracement. Let's zoom back out. Now, the next guideline we have to find our wave 3. We found where our wave 2 should be, so now we've got to find where our wave 3 should be. Our wave 3 is typically 161.8% the length of wave 1. Now we're going to need a different tool here. Now we're going to need our Fib Extension Tool. We're going to click at the bottom of where our impulse wave began. We're going to come up to the top of our wave 1 and then move the zero bound, which is the white line, down to the bottom of the 2 or the start of wave 3. And we're looking for the 161.8% extension of wave 1. And here it is. Strangely enough, that as well. Now, one thing I want to point out before moving on is the way I've set up my Fib tool, because everyone's different. Now, the way I've set this up is to express the values as percentages. Now, if these values were expressed as values rather than percentages, I wouldn't be saying 1618, I would be saying 1.618, 1.318, 0.618, and you will occasionally hear me do this and also say 61.8, and because I've been doing this so long, I've been using both of them for so long that they just slip out. and I tend to use both. However, I prefer to use it as expressed as a percentage, and I've been doing that for quite a while now. It's your own choice, so what you prefer, as long as the levels are the same. Okay, so moving on. The wave 3 we're most likely going to find it at the 1.618, but it can stop at the 1.318. Now, I often use the 1.318 when I'm looking at a very long and very big wave pattern over a long time period. I will often use the 1.318 in log scale and the 1.618 to see where I can locate a wave 3. Now, in pure price terms, we should be seeing it at the 1.618. If we go beyond the 1.618, the next likely targets are the 2.618, the 3.618, and the 423.6. And this would be a very overextended wave 3, but it can happen. However, if we don't make the 161.8, then we could go lower at the 1318, or below that we could be at the 100% extension of wave 1, or potentially we could be shorter than wave 1, although we are likely looking at a different kind of motive wave at that point, but it is still a possibility. The only rule which becomes relevant at this point is the area we have available to us in which the wave 4 must complete from here. The wave 4 must still finish above the wave 1 in order for this to be a normal impulse wave, and at that point the wave 3, although shorter than the wave 1, must still not be the shortest wave due to our rule 3, which means the wave 5 is going to be very short because it can't extend beyond the wave 3. This, although the symmetry is disgusting to look at for someone who likes to see nicely measured waves, it is still a legitimate impulse wave. The 3 is not the shortest, the 4 doesn't overlap the 1, and the 2 doesn't overlap the bottom of the 1. But the symmetry is not very pleasing to the eye, and it would be a very rare occurrence to see that happen, but it can happen. So just bear that in mind. We're looking for a 1.618, but if the 3 is shorter than the 1, or ever so slightly longer than the 1, then this will impact where the 5 can go. Right, so there you go, let's move on. Wave 4 is typically 38.2% of wave 3. So we're going to need our fib retracement tool. We come to the start of our wave 3, to the top of our wave 3, and see where our wave 4 retraced. It retraced to 38.2%. This is where we would expect to see it. The 4, however, can retrace as shallow as the 23.6, which is the next most likely Fibonacci target for the 4. After the 38.2 and the 23.6, the next most likely target for the 4 is the 50% retracement. However, to see a wave 4 go beyond this is quite rare, and at that point will be most directly related to an asymmetry between the wave 2 and the wave 4, depending upon the market you're observing. Now, this is not a guideline or a strict rule, it is simply an observation. I have observed trading commodities and equities and other markets that in commodity markets it's quite common that if you see a very, very deep wave 2 that's drawn out over a very long time, you will see a very shallow and quick wave 4 in terms of time frame. Also, I have found that if you find a very shallow and drawn out wave 2, you could have a very quick and sudden wave 4. These kinds of asymmetries don't tend to appear very frequently in equities markets, but they can appear quite often, not more often, but quite often in commodities markets such as oil, natural gas, copper and gold, silver, and so on and so forth. But since we're following the basic rules at the moment and basic guidelines, we're going to continue to use our targets over here. I'm just showing you the flexibility. As long as these rules remain intact, there's still quite a bit of movement you can play with. Now, having established the wave 4, we've now got the wave 5. The wave 5, in my experience, and through general observation of anybody trading Elliott Wave, will appreciate, has the greatest potential for variance. Now let's talk a little bit about why. When we're looking at the trend as an Elliott Wave, as an impulse wave, what exactly are we looking at? We are looking at market psychology. That is literally what the Elliott Wave is. Wave 1 is often the shorter of the main motive waves, Why is that? We've come off of a low, and the bulls are not particularly strong and there isn't much confidence in this asset. The wave 2 is a deep retracement typically of the wave 1 because the bears are still significantly stronger, or are stronger than they will be later in the trade, but they have enough power and enough influence to deeply correct the price, and the bulls are unsure enough and weak enough in their holding to allow this to happen. So the psychology of the wave 1 and the wave 2 is very much a time when the market is in a state of balance, and that is why the wave 2 can be quite deep. Now the wave 3 is when most of the institutions are going to be on board by now, and this is why the wave 3 can often be the longest wave. It doesn't have to be the longest, but it can't be the shortest, but it often is the longest. Institutional interest is peaking during wave 3. The bulls are getting stronger. This explains why the next wave in our wave up in the market is the wave 4, and this is only a 38% retracement as opposed to a 61 or 78% retracement. The bulls are stronger, the bears are weaker at this point. Now by the time we get to wave 5, this is when everyone and their cat is buying the stock, and this is where the FOMO traders arrive, the fear of missing out, and the retail investors arrive. This is, you could call this anything. You could call this your Bitcoin wave, or your Tesla wave would be appropriate recently. However, this wave is subject to all sorts of variations in length, because depending on the relationship of wave 1 to the wave 3 and whether or not it is the shortest wave will restrict how long wave 5 can be. If wave 3 has already fulfilled the rule of not being the shortest wave, that allows the wave 5 to go into extreme extension in some cases, but it doesn't have to. For example, let me explain. Wave 5 is typically 61.8% the total motive wave from the start to the top of wave 3. So what does that mean? Start at the bottom, bypass wave 1 and 2, go straight to wave 3, and then project the length of wave 1 and 3 from 4. And we should see a wave 5 which finishes at the 61.8%. This is the most likely place to find your wave 5, and the most typical place, but it is by no means a certainty, and is not as sure as the 61.8 or 38.2 retracements of waves 2 and 4 respectively, or the extension of wave 3. It is the typical place to find it, but is less certain. If we're not using that, we can use other wave 5 targets, are extensions of wave 1 projected from wave 4. These are 61.8, 100%, and 161.8 or higher. Now let's look at that. Take our wave 1, project our wave 1 from our wave 4. So all I've done is come up, click the bottom, click the top of wave 1, and move the 0 bound to the wave 4. Let's look at our first target, 61.8. The 61.8 results in what we call a double top. Now, although the FOMO wave can be extreme, you have to understand that the institutions having gotten in are happy to get out at the top of wave 3, and anything they make in wave 5 is gravy. Market sentiment can shift quickly between the wave 4 and the wave 5. There could be bad news about the stock. There could be a factory burning down. There could be a global pandemic. Who knows? Either way, the institutional strength behind the wave 5 is not there. We're talking FOMO investors and retail traders, and they are far more subject to market psychology, and so it's possible for the wave 5 to finish at the top of wave 3 as a 61.8% extension of wave 1. It is also possible to have something called a truncated fifth, where the wave 5 makes it to only 50% of this move and actually doesn't go beyond the wave 3 at all. Now we haven't broken any rules. The 4 hasn't gone below the top of the 1, the 2 hasn't gone below the start of the impulse wave, and the 3 is still not the shortest wave. So this is a rare, but this is a possible Elliott wave pattern of an impulse wave where the 5 completes below the 3. However, let's assume that after the wave 4 correction is over, market sentiment becomes more and more and more bullish. This can result in bubblenomics, and can result in people becoming extreme in their optimism and belief in the stock. This is why it's often called the FOMO wave or the idiot wave, or or whatever, because the whole point is to leave the retail investors holding the bag so that the sensible trader who's got in on the retracement wave 2 can leave at a profit. Now, I'm not attacking anybody. I've been in a wave 5, and we all have at some point, and we all got carried away. It's human nature, and learning from it is the best thing we can do. So let's carry on and project our extensions from wave 1 for wave 5. And we can see, oh sorry, I've got this wrong way around, extensions of wave 1 from wave 4, sorry. So we discussed other targets, the 100% of wave 1 and the 1.618. Now, this box here, between the 100 and 1.618, in the middle of this box was our projection of the total length of 1 and 3 that we did earlier, projected from 4 as a 61.8% extension of that total length. So you've got quite a big area where the wave 5 could end here and settle, but there's no reason why it can't go beyond that. It could go to the 2.618, it could go to the 3.618, and it could just keep going as long until it eventually stops, because it always does in the end. The only rule here that matters, we are still not breaking any rules. Okay? The 2 is not retraced to 1, the 4 is not retraced to 1, and the 3 is not the shortest wave as the 3 is longer than the 1. So under these circumstances, the 5 can be extreme in its extension. But as we already discussed, it can also be shorter than the 3 and blah blah blah. In other words, the 5 is the least wave, the potentially most rewarding wave if you're in a bubble, but it's also the least safe to trade. As opposed to, and there's a reason for that. This is where the arguments are saying it's impossible to call the top. No one rings a bell at the top. You've all heard the sayings. So that's because wave 5 of the impulse wave is the hardest to predict where it's going to finish. So if you were trading this and you saw a move up off of the low, which wave do you want to buy? Well, quite simply, the safest place in this entire, you'd love to buy this, but you've got to call the bottom exactly. Not likely, because for the same way as discussing where we're going to find the top of an impulse wave, we would have been dealing with a corrective wave moving down here, and finding the bottom of a corrective wave, the bottom, can be equally tricky. So the safest wave to buy in the market, or to sell if you're going down, is here. This wave 2 retracement gives you maximum potential for return with minimum loss. Right? Now you don't have to, of course, set your once you've got your free wave structure that you've been observing, which we'll cover in the next video, which are the corrective structures. Once you've got your corrective structure and you've got a 61.8% retracement and you get a bounce, you can buy in this zone, and then you can set your stop just below the 61.8 or at the 65 perhaps, and if you are wrong and this is going down deeper, you'll be taken out at a minimal loss. If we do bounce and continue higher, you can just let this run and move your stop up as it continues to go. And that is the first lesson in Elliott Wave theory, covering the impulse wave. I think I've covered everything I need to, guys. If you're new to the channel, please like and subscribe, smash that like button. If you're a constant viewer, smash the like button anyway, and I would appreciate comments from all of you as to what you think of this series going forward. Is it a good idea? Do you appreciate it? And also, am I presenting it in a nice simple way where you can understand? That's it, guys. Thank you for joining me on this first video of a new series. I wish you all the best. Please take care of yourselves out there, and I'll speak to you soon.